What is a mortgage interest rate and how do you calculate it? It's a question that we get asked a lot, so today we're going to be breaking it all down in today's video. But before we jump into today's video, if you're wondering who is this guy and why am I telling you what to do, it's completely up to you whether you listen to me or not. But my name's Josh Tomlinson. I'm the managing director of My Mortgage Finder. We are a mortgage brokerage that help people get on the property ladder and remortgage their homes who have bad credit. We arrange about £100 million worth of bad credit mortgages every year, and we have a team here of over 30. First things first, a mortgage interest rate is the percentage of the loan amount that a mortgage lender will charge to help you buy a home or refinance your home. It's one of the key factors that determines how much you're going to pay every single month and also over the lifetime of the loan. Usually, the higher the interest rate is, the more that you're going to pay overall, and usually the higher that your monthly repayments are going to be. The lower your interest rate is, the cheaper it's normally going to be over the lifetime of the mortgage, and usually the lower your monthly mortgage payments are going to be as well. So now you know what an interest rate is, but how do we calculate it? Let's go ahead and take a look at how this would work on an interest-only mortgage. First of all, I'm going to talk about how this would work on an interest-only mortgage first of all, because with an interest-only mortgage, you simply pay the interest every single month, meaning that the balance of your mortgage, providing that you don't overpay, will stay the same throughout the term of the mortgage itself. And because the mortgage balance doesn't actually decrease, then the calculation here is very simple. We're just going to take the loan amount and we're going to times that by the interest rate, and that's going to give us the total amount of interest that you're going to pay every single year. So let's go ahead and put this into a real life example. Let's say, hypothetically speaking, you're buying a home of £100,000 and you're putting down a £25,000 deposit. That means you're going to be borrowing a loan amount or mortgage amount of £75,000. So let's go ahead and say that you have been charged an interest rate of 6%. Then we're going to have our loan amount of £75,000 times by the interest rate of 6%, which is going to give us total interest payable in the year of £3,500, which on a monthly basis is going to be £475. That's how much your monthly mortgage payment would be if it was an interest-only mortgage and how much the interest would be every single month. So where it can get a little bit more confusing is that when most people buy a home and most people take out a mortgage, they do so by taking out something called a capital and repayment mortgage. With a capital repayment mortgage, this means that you pay back together the capital and the interest in one payment every single month. And most lenders now calculate this using daily interest. And the reason that most lenders use a daily interest calculation now is because the interest rate and the interest is charged daily. On a capital repayment mortgage, the balance of the mortgage goes down over a period of time. So by using that daily calculation, it takes into account the reduced balance of your mortgage, which means, in theory, the amount you're paying in interest will drop the further into the loan that you get. So let's go ahead again and use the same example that we used previously. And we're going to say that the balance and the mortgage that we're borrowing here is £75,000 and the interest rate that we're being charged is 6%. So as we know, the interest calculation would be £75,000 times by the interest rate, which is 6%, which over the space of a year would be £4,500. So for the daily interest calculation, we're going to take the £4,500, the annual interest, we're going to divide it by 365, the number of days in the year, which is going to give us an approximate daily interest of £12.33. So on the first day, you're going to pay approximately £12.33 in daily interest. And as you make your monthly mortgage payments over a period of time, the balance is going to go down. Each day, the lender will recalculate your interest based upon your new mortgage balance. So whereas it might start at £12.33 interest per day, that might go down to £12 and so on. But rather than try and calculate this yourself, you can probably just save yourself a lot of time and look up an online tool using a mortgage repayment calculator, And this will ask you for things such as the amount that you're looking to borrow, the interest rate that you might be going on, how long you're going to take the mortgage term over, and whether you're looking for a capital repayment mortgage or an interest-only mortgage. This will then give you an indication of the amount of interest rate that you can approximately expect to pay over the lifetime of the mortgage itself, and it will also give you an assumed monthly repayment as well. I'll pop one in the description below that might be helpful. It's just one from the money saving expert, and hopefully that can give you a starting point. So there you have it. You now know exactly what an interest rate is, and you know how to either calculate it yourself or use an online tool to help you. If you do have any questions, feel free to pop those in the comments below. Alternatively, you can send us an email using the email that we've put in the description. So thanks for watching. Please make sure that you turn on the notifications for more tips on bad credit and all things bad credit mortgage related, and we will see you in the next video.